What's up, Outliers? Welcome to episode 3 of Outlier Options Trading Basics, which I did rename from Foundations just to make it a little more clear what we're doing here. We are on episode 3. Our first 2 episodes covered a couple different things. First episode, which is this link here, I will throw that into the chat. This one talked about how we can take a market perception, something we think may or may not happen, and turning it into a trade. Then episode 2 was discussing using the Greeks to make decisions with respect to said trade. Now, this session today is about managing and then ultimately exiting those trades. Before we get too far, gotta say hello to everybody that's hanging out on a Friday. I already see a bunch of you guys already liked the video before we even started, so that's a vote of confidence. I hope I will not let you down, and thank you for doing that. Looks like we got Reese, ZX, Todd, Lauren. Great to see you all. And we are ready to take the next step. Now, when we think about this concept of managing positions, the reality is the majority of traders, as you might guess, really don't think through this that well or much at all, unfortunately. And funny enough, right before this podcast, not long ago, I was talking with you and Sinclair for an actual podcast episode. And the theme for the podcast episode was retail compared against institutions. And some of the things that overlay well, some of the things that don't, some of the skills that you guys should consider onboarding and some that you shouldn't, and so on and so forth. One of those things that we talked about was a scenario that I think a lot of you might identify with. So let's just start with the scenario. Let's say that you've been working on a strategy. Let's say that you did your research, you did your back testing, you found that IV coming into earnings is typically elevated relative to RV. Up here is IV, down here is RV. And you decide that you want to sell vol through earnings. So sell earnings, release vol. You sketch out a plan based on this idea. You do some rudimentary research, some testing. You say, how might this have worked in the past? And you land at a very basic approach. You effectively say, I'm going to sell to open a straddle day before we go into earnings, but right before the close. So we're going to sell to open the straddle. And then you open the market the next day. The underlying has a massive move, and then your straddle loses. At this point, a trader typically will say to themselves, that sucks. Maybe this one was just a fluke. Let me do another one. And then we do this again. And the same scenario happens. You've now lost 2 in a row. You've chosen to trade this earnings release effect, and you've done 2 in a row, and they're both losers. What most traders do at this point, or somewhere around this point, is they say, this isn't working how I thought. I probably messed something up. I missed something. The effect has changed. There's something wrong with what I'm doing. And then we leave. We don't do this anymore. We don't do this anymore. And then we go try something else. We go take our ball somewhere else. The issue with this is without thinking through how you plan to manage a trade, what it might look like, and thus your exit protocol, you are entirely susceptible to this exact thing. And a host of other issues. I'm just picking one for this example. Let's take a look at another example. Let's say that you're trading a new fancy breakout strategy that you came across. The way that you're supposed to trade it is you have a stock chart, price is going like this. Before this part happens over here, you see the setup that you've measured, you've tested, you understand what a consolidation range is. You have clear signals on when your breakout entry should occur, and you get in. Except it doesn't do this. You get in, it goes here, and then it rolls down. Maybe not that far. That's a little dramatic. Let's say it goes down in there. As it's doing this, you're sitting there scratching your head saying, this is going the wrong way. What should I do? If you're in the middle of a trade and the statement ever comes out of your mouth, what should I do? That is a massive red flag. That is a problem. Now, that doesn't mean it will never happen. Things happen that aren't ideal, and it doesn't mean that it's not navigable. It is. But one of your underlying projects as a trader is to do everything in your power to completely reduce the frequency of you saying to yourself, what should I do? At the end of the session today, there's a couple clear takeaways that I have in mind for you. The first one is creating a plan, a management plan. The second thing is reducing instances. What should I do? That should go down. That should happen way less frequently. And your goal is to not say it. It shouldn't occur. If you're trading well and you've done the corresponding work, this doesn't happen. It literally doesn't happen. I cannot tell you the last time that I was in a trade where I was legitimately saying to myself, what should I do here? Now, I will say sometimes to myself, what do I want to do? Because there might be a couple different ways I might be thinking about managing something. But it's never in the context of, I have no idea what to do, and I'm trying to figure that out. We need to not, oh shit, there's that menu again. I don't know how to do that. We need to not build the plane as it's flying. This is no good. There's never an optimal time for this. It's never better to do this. It does nothing positive for you in any sense whatsoever. This shouldn't be a thing. So at the end of the stream tonight, you're going to learn genuinely how not to do that. And it's not that difficult. That's the cool part. That's the beautiful part about the session today. That's why over the course of the next 50 minutes, you'll be able to at least walk away with some pretty profound structural changes, or at least paradigm shifts, because nothing that we're going to talk about is that fucking complex. It's pretty simple shit. And I will literally show you. We're going to take a look at it together. Now, before we get too far, I think it's important. I asked you guys to do a piece of homework. The piece of homework I asked you to do was without external aid. So this means without using AI and without Google searching stuff, to outline your own approach to management, like the way that you think about it. And if you've not done that, I mega ultra highly super encourage you to do that now. You will have a couple moments before we get into the weeds. I think doing that exercise is really, really important. When I'm teaching somebody a jujitsu move, there is a showing phase where we illustrate the thing that they're supposed to do. Then there's the learning phase where we drill it on a passive opponent. And then there's like an application phase where we actually execute it in a more live scenario. That really, really, really helps learning rather than just watching. The uptake and the purpose of doing things like drills is because it increases your speed of learning tremendously. So that's what I'm asking you to do. Conduct a drill. And it's for your own benefit. I will have no idea if you did it. I also genuinely don't care if you do it, but I think you should. Okay. Lecture done. Let's talk about this trade management thing from a high level. And I want your help here. When we're thinking about trade management, what are the kind of things that we need to do? Just throw them in the chat. It can be anything. It doesn't have to be in a particular order. Just list the things that you think need to happen. So Better Grab Chalk, which is a great name, says high level or strategy. Well, believe it or not, you already gave a good answer, which is strategy, rules. There's our first one. We need to refer to what it is that we think we're doing. Lauren says, taking trades down when I'm at a loss, 25% loss. Okay, so what you just listed there, Lauren, and it's not a surprise to me that that wouldn't work well. Why would it, right? It's just a random number. So that doesn't surprise me in the least that it's not working well, which we can talk about. But what you are highlighting there at a higher level is loss management. So we need to have a plan on how we're going to manage our losses. What else do we need to do? We have two things so far. We need to understand the specific strategy that we're trading and what that calls for, which we'll talk about. And then we need to have some element of loss management in place. What else? What other stuff do we need to do when we're thinking about managing a trade? Again, it can be anything at any part of this chain. So other things that come to my mind to phone a friend and help you guys out is expectations, also known as targets. There's profit management. There might be some sort of time management, not your time, but time in trade, good old tit management. What else could there be? Event monitoring, correlation, some of this stuff gets more at the portfolio level. The main thing that I'm trying to highlight here is that there are several really important things that we're doing here. Reese just hit a super important one: sizing, scaling. Super important. If we boil all this stuff down, all of these individual tasks, and we turn them into something simple, something that covers most of the bases without getting really specific too fast, there's really two broad things that have to happen in here. The first one is profit management. The second is loss management. Everything else in here kind of falls into these buckets. Now, again, you could argue slightly otherwise, but my main objective here is not to oversimplify it, but it's to give you a mental model to consider. Pretty much everything that we need to do over the course of a trade life cycle falls generally into these two buckets. Why does this help you? It helps you because now you get to ask yourself questions that will help you identify the shit that needs to happen. So for example, one of the questions that would belong here is, how do I manage my profits? How do I do that? That's a super important question. I'm actually working with a friend right now who has a position on that is very significant to their total investable money. And it's one of those really interesting scenarios because they genuinely do not have a plan. They got into something because they think it's going to go up. It's gone up. They've done well, but there's no real plan at this point. It's just kind of this nebulous thing. And the problem is, if you go into an environment that can stress you out, the probability of making good decisions with that as the backdrop is about fucking zero. The probability of making any sort of optimal decision is super, super low. And we need to avoid that. So let's talk about this general process now. We have an idea of some of the things that we need to do. I want to talk about, before we get into the process over here, I want to talk about some shit that we shouldn't do, not do. And Lauren already hit one of them, which is wrote P&L based exits. This doesn't make sense. It just about never makes sense. Let's deconstruct what I mean by this. This means you guys can see SPY above my head, right? This graph, I think you can see it. So let's say that you got into SPY here at 670. And you say to yourself, I don't want to lose more than 10 bucks. That's all I want to lose. So then if SPY goes to 660, you get out. This is completely and utterly arbitrary. It is based on nothing other than you not liking this number. That's it. This is not based on a market effect. This is not based on a signal. This is not based on profit mechanism behavior. This is literally just based on you saying, I like this number, I don't like this number. This is completely and utterly insufficient. This is not a way to manage positions. And we'll talk about the correct way to do it in a few moments. But this is one. The next thing is generalized. So as Reese, better known as Better Grab Chalk, mentioned earlier, the first thing Reese said is that depends on strategy, though. What does that tell us? They obviously already grasp this very important concept, which is if, for example, I'm trading short puts and I'm trading long calls and I'm trading iron condors, whatever, if I'm doing any of these and my management approach for all of them looks the same, what do you guys think? Like, does that logically make sense to you? Does it logically flow that the thing that you would trade a short put in would have the same management protocols as the long call or iron condor? Right? Like, if we sit there and think of it just at a logical, not even worry about any details, just at a sniff test, does this fucking make sense? My guess is probably not. Most people would clearly see that these are different things. They behave differently. Some different stuff is going on here. Better Grab Chalk says, nope, different profiles. That's exactly correct. They're different things. So another really, really common thing that you should not do is convenience-based. This is, oh, I can only do this, or I only like to look at two names, and it's easier for me to just exit stuff at 12:30 p.m., whatever it is. That's convenience-based. That also is not going to fly. It doesn't work well. And again, if we go through this and you start to say to yourself, like, man, that kind of sucks. Like, this is actually a little more complicated. There's some more stuff that has to get done. I don't know if I want to do that. That's okay. You don't have to do it. But what that means is trading probably is not a great fit for you. And that's okay. It's not a great fit for really most people, realistically speaking. But you kind of have to keep it a buck with yourself, because when it comes to trading, anybody that's on the stream and familiar with my work, you already know the hallmark of the way I view trading. It's the kind of thing that you genuinely can make a shit ton of money with no specific background, in no specific time frame, but there's a trade-off for that. It takes some effort. It doesn't just fall out of the sky. So if you're able to embrace the work side of it, that's when the return side of it starts to take shape. Okay, so we have some ideas on the primary tasks that we need to do. We have some ideas on some of the things we want to avoid. Let's talk about trade management now. I want to start this by introducing an important concept that I genuinely hope you will keep in your back pocket, literally forever. When we're doing something like this, the way that my mind visualizes it is not, how do I manage my short put position? That's not what my brain does. When I see this, my brain instead is saying, how do I create a process that I can use effectively across the board? But we just mentioned that we can't necessarily have the same parameters across the board. Of course not. We can most certainly build a process that can be applied across the board. So let's just give this a shot together. If you were to begin creating a process for trade management, what goes in here? What do you think? Don't worry about the order. We'll figure all that out together. Just what are the things that we need to do in terms of a process? You already have two of them that we talked about before, the two big buckets. We already know the first one is we need to have some sort of profit management. And you already know that we need some sort of loss management. Okay. So let's now go deeper. What are the other things that we have to consider? Better Grab Chalk had something earlier, which is entirely applicable. They had said, how do I know when I'm right versus wrong? So we need a hypothesis, and then we need to attach this to some sort of metric. So for example, if I think SPY is going to go up to 680 in the next 3 weeks, that's a detailed, or at least more detailed, hypothesis. That not only includes a directional assumption, but it also includes a time assumption. That's one of the most commonly missed elements that retail traders, especially options-based retail traders, miss, is that not only do you have to make an estimate in terms of direction and severity, but you also need to make an estimate that's time-bound because options expire. You do not have the benefit of just buying something and then being perpetually wrong and just holding on to it. It's going to expire. So that's not a choice for you. If we take a look at a logical way to build this out, it's really, really simple. When we're first placing a trade, the only thing we can control is our risk. So this is done via sizing. That's the first part of your management plan. Now, again, I'm kind of bouncing a little bit between like setup and management, but I don't have a setup section, so I'm making sure some important pieces find their way into this section. Sizing. You need to determine what the size is of the thing that you're going to get. We just talked about we need to have an idea. We need to have a hypothesis. In this hypothesis, it needs to be direction. It needs to be time. And it needs to be severity. That's the next input to your trade management plan. Notice how we didn't say anything about roll your trades at Y%. We did none of that yet. We're literally just talking about things that apply to quite literally every single position you could possibly put on ever. That's what this is so far. Applies to everything. So we have our risk sizing idea. We have a hypothesis. We have a thing that we think is going to do something. The next part of your trade management plan could be part of hypothesis, but I'm calling it out directly, is a profit mechanism profile. What does this mean? If I'm trading short vol, and let's say I'm selling straddles. If I'm selling straddles in, let's say, utilities stocks within the S&P 500. That's scenario 1. Utility stocks within the S&P 500. Scenario 2 is I'm selling vol, same short straddle structure, but I'm doing it in biotech. Same structure, same general profit mechanism, short vol. How different do you think those two things might be? If I'm trading short vol in S&P utilities names, or if I'm trading if I'm trading vol in biotech. We already said it's the same structure. It's the same general profit mechanism. It's the same overarching profit mechanism. In this case, we're looking at variance risk premiums. But the difference in the behavior between those two are massive. And again, we actually just did a session yesterday for the pro members. We built a volatility sizing tool, which really helps elucidate this point. But the Cliff Notes version of this is, if you do that, if you use vol as part of your input, you'll notice that you'll size things very differently, as you should. Brian says, you're a man if you're short straddles in biotech. Believe it or not, that's probably one of the best possible places for retail traders to sell vol. Like, straight up. It's actually funny. It's hilarious you said that, because you and I talked about this same exact thing today. The irony here is that retail traders feel so safe in things that they shouldn't, and they feel unsafe in things that are probably healthier for them. And it's a primary example, because somebody might prefer selling some sort of short straddle in something that's more boring, that doesn't move a whole lot. Utilities names, for example, you feel safer. But the funny thing is the probability of you actually walking out with some sort of like reasonable edge is not high, and your asymmetric loss factor is still there, crash factor. Whereas in something like biotech, there's actually really, really fat risk premiums. They have their own risk premium. And it's because when biotech is going into phase trial release or some sort of approval, they tend to, just like earnings, be super, super vol heavy. And the return on your risk taken is actually much greater. And even though you might experience some sort of massive move, it's probably a lot more tame than you might think. And I'll actually give you an offshoot example for this today. Literally today is a great example of this. Today, I traded yesterday, I traded QXO for earnings. And if we stroll on over to the platform real quick, I'll hide this stuff. Let's just take a look at QXO, what this bad Larry looks like. Now, the chart here doesn't really look like much, does it? It looks like it closed at 16 and it found its way generally flat here. But as a relative move to itself, that's still a pretty healthy size move for the underlying itself. And its move at the end of the day ended up being, 6.5% or whatever. Yet, even though this had a fair move for itself, it still was highly profitable, even though the expected move priced into the options was only 5.4%. It was only 5.4% priced into the options. Yet, it still was profitable, even though it moved more. Vol. So a lot of times traders, I think, really misconstrue and do an insufficient job measuring the actual risk that they're taking relative to other inputs. And it leads to these really false senses of security. Ewan shared something that I 100% mirror and think the same, which is newer traders have a habit where they're like excessively fearful of small moves and not fearful enough of potential significant moves. That's effectively what that is. But yeah, anyways, a little bit of a sidestep, but the cliff notes there is biotech is actually one of the best possible places, especially when it's wrapped around some sort of event. You just have to size things smartly, which if we go back to our trade management, that's actually step one. We have to size things appropriately. The way we figure out what's appropriate for sizing starts at the portfolio level, then it goes to the strategy level. So here's what this means. At the portfolio level, I might give myself a mandate. My portfolio level mandate might be I, on any one single trade, do not want to lose more than 10% of my entire portfolio. I can pick a number. And this number still needs to make sense relative to what you're doing. Because, for example, if you're investing in S&P 500 and dollar cost averaging, you're going to run over this. You're going to hit this, right? But if you're trading options in a well-constructed book that has multiple things going, then maybe this might make sense. But that's the portfolio level imperative. Then, based on your profit mechanism, then you attach your second metric. This second metric is typically the more specific one. The way that I set up my personal portfolio is the portfolio level imperative gives me a lot of room to move. And then the profit mechanism, typically speaking, is tighter than this. So I always give myself a little bit of room, but I'm really protecting against catastrophic outsized moves. Yet, for the profit mechanism itself, normally speaking, it's going to be a little more restrictive than the portfolio level. If there's a scenario where the portfolio level exceeds the profit mechanism, well, it doesn't matter. The profit mechanism in that case would supersede. It's whichever is lower. That's ultimately what the decision is based on. This is determined from testing. And again, this takes for granted that a trader is making some logical decisions. Some of those logical decisions are they backtesting strategies? Are they tracking their results and understanding how the thing is that they're attempting to trade behaves? Like, those are the granteds here. You need to do those. If you don't do those, and a lot of people don't, they will just pick something random. And again, as we talked about before, just rote application isn't going to work. Why would it? It logically doesn't flow, even if we think through the thought as a thought exercise versus actually risking money to do it. So we have 3 steps so far. We have risk sizing that needs to be completed. We need to determine a hypothesis that's bound by these 3 concepts. We then need to determine what the profit mechanism itself behaves as, and then we need the strategy. Now, inside the strategy level, this is where there's more detail. Because up until this point, these 3 points automatically apply to everything no matter what. It's once you get to the strategy level that you start getting way more specific relative to the specific strategies. And it's really these two things coming together that now matter a lot in terms of what other things you might overlay. Before we go into the world of strategy, I want to zoom out ever so slightly, and I want you to think of this in terms of a series of questions that you're going to ask yourself before you enter. The first one is, am I sized correctly? This is with respect to risk. The second thing is, what do I think is going to happen? Again, that's this one. The third thing is, when do I get out? If I lose. Fourth thing, when exit? If win. Fifth thing is, when exit? If other. If you walk out of planning a trade and you can discreetly answer all of these, you're probably in pretty good shape. So you really have 5 main questions that you need to solve for. Am I sized okay? What do I think is going to happen in terms of direction, in terms of time, in terms of severity? When do I get out if I'm incorrect? Where am I wrong, as I like to think of it? And then when do I get out if I win, or where am I right, as I like to think of it? And then when do I otherwise exit? Because there are plenty of scenarios that can exist where you might be in something that isn't necessarily hitting either of those benchmarks, either hitting your profit taking or your loss taking points. You can have something that's trading in between those. But even though it's not hitting those points, it's still consuming capital, which carries with it an opportunity cost. So that's why there typically, for me, is a conditions-based or time-based piece to this. Conditions-based can be, let's say, for example, pull this stuff away for now. Let's say, for example, let's go to SMR. This is actually a good recent example. SMR. So one of the things that I really want SMR to do is go up, because I think it's a cool company. But that part, obviously, it's not doing what I want. It's being a little bit lame, makes me sad, but maybe there'll be an opportunity at some point. That would be sick. I need to finish creating these alerts, though. Now, let's say, pretend like these last couple candles weren't here. Pretend that this one wasn't here, and pretend this one wasn't here. Pretend it was like just this. If I was trading a ratio call diagonal, and let's say that I got into the ratio call diagonal here when it was 39.80. Again, full transparency, I don't have anything in here right now, but let's just say I did. And I got in here. If I'm holding this from the 3rd, 3.9, and I fast forward to this point, I'm now at the 29th of that month. So about a month later, 25 trading days later, nothing has happened at all. If I'm trading, let's say, a really long dated ratio call diagonal, what do you guys think? Do I care or do I not care? What's your guess? Care or not care? If I'm trading, let's call it a 400 plus day ratio call diagonal, does this matter to me or does it not? What do you guys think? Not care if it's that long. It's a great guess. Yeah, don't really care. Doesn't matter. It's about a month, but with something that is that far out, doesn't matter that much. Exactly. And ZX phrased it perfectly. If it's that long term of a thesis, I don't really care about the short term that much. Doesn't really matter. A great example of this is Palantir. I'm still trading, full disclosure, a ratio call diagonal in Palantir. I do have a position in here. Objectively speaking, from here to here is a solid down move. That's down 18%. It's a significant down move from high to this pullback. But in the grand scheme of things, I don't really care. Why don't I care? Because my position has been established some time ago. So even though this move isn't necessarily super fun from here to here, in the broader scheme of things, let's just say that there was a position that was entered like the middle of last year. From there to here, it's a 600% return. And then from here to the high, it's 737. Much nicer at the high. It's better, but this is still fine. And as long as the long-term thesis is still intact, this short-term move doesn't really matter. So what I'm expressing here is that there's a sense of what becomes relevant. If instead I was trading a 30-day or a 60-day ratio call diagonal, or even a 90-day ratio call diagonal, that month of nothing does matter, which is exactly why there's that when exit if other. So if I don't hit my loss target and if I don't hit my profit target, that doesn't mean that I just hold the option until it becomes my loss. That's not how that works, because I know it will, right? If my option is out of the money and it's slowly decaying to zero, that doesn't help me. So when we're thinking about our trade management, it's not just managing in terms of when you hit some sort of profit or when you hit some sort of loss, but it's also when is your idea incorrect? Like when is just the general idea not playing out, even if it's not hitting loss or profit management targets? Okay, I think that point has probably been beaten to a bloody pulp. I want to linger now on this idea of strategy-specific inputs. And this is exactly why I am a massive advocate of having a trading plan, which includes strategy outlines and then a corresponding trade log. I have videos for all of these. You can build your own. It's not difficult, and you should do it. There's no reason not to. You should do it. Purpose of the trading plan organizes your thoughts. Strategy outline is where we literally are going to explore these details right now together. The trade log is where you validate this shit. Does it do what I think it's going to do? And I'll explain why. In the strategy outline, there's a couple key sections, but I want to focus on really two of them. There's the setup, and then there's management. Now, again, like I was saying before, setup includes stuff like this, like risk sizing, scanning, signal overlays, and shit like that. But the management piece of this is really, really important, because going back to the example that we had earlier, we had a trader that was saying that, they choose to exit when they're at a 25% loss. Seems logical. The problem is it doesn't really matter. You have to base your management decisions on the strategy, which is based on the behavior of the profit mechanism. So let's say, for example, I'm trading something like a breakout. Let's see if we can find something like something that looks like it might be primed for an actual breakout. I'm not going to spend a ton of time on this. I just want to see if there's something that just even remotely looks interesting from a quick look, because I think that would be a better example. Let's just take a look through some of these really, really fast. Now, sort of, that's the closest one. We could use that one. Oh, this one's fine. Let's use this one. So this one has been, this isn't like a actual breakout, but this is fine enough. I don't want to get too stuck. Let's say that this thing has been oscillating sideways. Fuck. I can't get over it. Sorry. I wanted to be a bigger man and able to get over it easier, but I couldn't. Just couldn't do it. I tried for you guys. Ooh, maybe this one. Okay, yeah, this one's better. This one's way better. Okay, cool. So this thing had a little bit of a rally. Again, this isn't a great breakout, but I can work with this one. And it's consolidating for a while. With the earnings event, it tried to break out, came back down, and is now in this consolidation range. If I want to trade this, and my hypothesis is when it breaks out, it's going to break out on specific signals. But when it typically breaks out, we expect to see this kind of movement here, actually, where, let me zoom this out a little bit more, where you can see like this thing traded sideways. It came into a catalyst, and then this is like picture perfect post earnings announcement drift. You get a nasty breakout to the upside, and then it just rips. So this move in the first several days of this breakout is 22%. That's 22% over 5 trading days. Significant move. Now, the way that I'm going to manage this kind of trade is completely different than the way that I'm managing the short vol through an earnings release. They're fundamentally different things. So when you're deciding how you want to manage a trade or when you want to exit a trade, that becomes the ultimate crux of your decision making. Once you get through these details of, am I sized okay? What's my hypothesis? As soon as you get to these conditions, 3, 4, 5, when do I get out if I'm wrong? When do I get out if I'm right? Or when do I get out if neither of those conditions hit? Those 3 are built specific around the profit mechanism that you're trying to trade. So if you do not have a clear understanding of the profit mechanism that you're trying to trade, there's no world that you're magically going to have some sort of great idea on how you should manage it. Again, logically speaking, why would you? You can't know about something that you don't know about. It doesn't really work that way. The homework here is to define your profit mechanisms and to spend some time getting familiar with them. Based on the specific profit mechanisms that you're trying to trade or capture, you should be able to profile them, come up with some specific traits about them. So going back to this example, if I'm looking at post-earnings announcement drift, based on my own research, there's certain traits that I expect to see. And based on those traits, there are certain metrics that I expect to see. So traits being things like, did it beat on EPS? Did it have a gap? What did option sentiment look like coming in? And these other factors that I look for. And then the actual behavior that I would expect to see is the gap on earnings. And I would expect to see some sort of broad continuation over the next 5 days. A lot of that will occur within the first few days. That's kind of like the initial surge of post-earnings announcement drift. Then from there, if there's a continuation because of slow institutional involvement that continues to scale in on heightened volume, then you start to experience the drift element of it. So based on those qualities, I can make some easy decisions on how I want to manage this. So for example, if I had been trading this, my exit would have been somewhere down here, like right below the pre-breakout lows, the prior consolidation before the breakout, those lows. Why? Because it's a tight enough stop that doesn't get hit frequently if the idea is intact. So what did I just say there? Oh shit. Whoa. My little writing pad can be insanely sensitive. What I was saying there is if my exit is here, I know based on the quality, the specific traits of the post-earnings announcement drift profit mechanism, that when this condition actually occurs, moving full way into fruition, that it exceedingly infrequently will make this gap up, revert down below these lows, and then continue back up. Now, again, to be super clear, that does not mean that it cannot happen. It can do anything it wants. But remember, our job as traders is not to find that one unicorn where that shit happens for some strange reason. Our job as traders is to trade a process-based idea. So in this case, I know for a fact that the instances where it will do this kind of thing, although it might happen once in a while, in general, ain't gonna do that and still exhibit the ultimate behavior that I want. So because of that, by placing my stop there, I can decrease my total risk taken, increase my potential profit. And what I'm avoiding is placing a stop at some point that often reverts back. What's an example of that? Really, really easy. The people that are trading zero DTEs and they're using stops. So let's say that you sell the zero DTE straddle, and let's say that you collect $8 total. So this is, the expected range that you're looking to play. What people will do is they'll say like, okay, if this straddle trades at $16, I'm going to get out. It means that I'm wrong. The problem with this is there can be, and specifically with something that is that tight as 2 times, plenty of instances where it would go from $8 temporarily to 16, but then back out and expire worthless. So by stopping yourself at this point, you're actually ruining the profit mechanism that you're trying to capture. How do you identify this stuff? By fucking testing. If you do not test anything, you will not know this stuff. And then you will be the lazy retail trader that's arbitrarily exiting at 2 times the credit received because that's the number you arbitrarily picked. And then you will be trading something that has actual edge, but then managing your way out of the edge. Sick story. Unfortunate, but quite literally happens all the time. Let's summarize the main pieces of this, and then I want to make sure we have a few minutes for questions. When deciding to manage a trade, how you're going to manage a trade, you need to start by building a process, a management process that you're going to use to outline how you're going to approach trade management broadly. In that, I think a great starting point are those 5 questions. Am I sized? Okay. What do I think is going to happen? When do I get out if I'm wrong? When do I get out if I'm right? When do I get out if neither of those 2 instances occur? When do I get out? Those 5 questions. If you can answer those logically, then you're probably in a pretty good spot. And the cool part is that automatically handles the second part of the topic for the stream, which is exiting trades. When you exit trades in one of those 3 conditions. Based on your hypothesis, when you're wrong, when you're right, or when neither of those are hit and enough time passes or some other event occurs. So the reason why I say other events or other things is, let's say, for example, here, let's say that you were trading net. And as net is oscillating sideways, you now see that you're coming up on earnings. You don't actually want the earnings risk. That isn't what you're trying to trade. So even though you might not have hit your loss management point or your profit management point or enough time in the trade, let's say that you still had plenty of runway on your trade, but now there's a catalyst that's coming down the pipe that might actually, again, change how you would want to manage that trade. That's the example. That's another example that's not just time-based, although you could argue it's also time-based. But in that case, it's definitely primarily based on a catalyst because we're going under the assumption that you still had enough time left in the trade. Okay. What questions do you have? When you're thinking about managing a strategy, managing a trade, what are your current sticking points? What do you struggle with? What are you having difficulty figuring out? And let's figure it out together. Because again, like I said, the cool part is it genuinely is not that hard. You probably just need some direction. Talk to me. Where are you guys at? And then if you guys have no questions, that's also cool too. That means that obviously I did a absolutely stellar job. But my guess is that there's a couple. So Reese says, when to take profits on a winner? It's a great question. The beautiful part of that is the same concept that we actually just discussed with respect to a loser is what we do with profits. So here's how that works. Let's say we're trading a breakout strategy. So something that looks like this, and then it oscillates sideways, and then it has a pretty big breakout. The question here typically is, okay, I had a really good entry. My original stop was here, somewhere down here, and now it's doing what I want. When do I get out? The easiest way to figure this out is profile the profit mechanism. The way you profile the profit mechanism is by measuring it. You should be able to say things like, based on stock price, if the breakout for this specific setup occurs, on average, the underlying moves 10% over 4 days in a favorable direction. If that occurs, you've hit the average of when it tends to happen. Then you can say, how does it typically behave if it doesn't hit that 10%? How does it behave if it blows past that 10%? And then you can apply a few different ways. One way is you could say, okay, once I get to that average move, I'm actually going to take, let's say, a third or a half of the position down. I'm going to take some profit so that then what's remaining is effectively lower risk now. And then I can just give it more time to continue to make the move. This is also where signals become really, really important. So part of the thing that I would do with this specific profit mechanism is I would overlay different signals. I would say like, well, how do like moving averages help me identify this? How does some sort of relative strength index or oscillator help me capture this broader momentum? I would say like, okay, well, I noticed that if I use a really, really short-term moving average, let's say like a 5-day moving average, I noticed that I would get stopped out all the fucking time. So that's way too short. That doesn't work here. I would miss too many of these moves. So then instead of maybe that short, maybe you find something slightly longer. And let's say that instead you're using a 10 or 20-day moving average for this effect. And you kind of notice, you're like, wait a minute, when I use this slightly longer term moving average, it's not really closing below this too much. And in the instances that it does, it actually tends to kind of rally back up and out. So then maybe instead of some sort of hyper-specific rule where if it touches or crosses below, maybe you need a close below that's a certain percentage off. Then you can test that idea and see. So to summarize, the way that you determine on when to take profits is actually applying the very same exercise you use on when to get out to the loss side. It's the same exact thing. You have to profile how it behaves when it works in your favor. And then you have to strike a balance between giving it enough room to do what you want and not artificially undoing too much of the move itself. So for example, this here is a 10-day moving average. This here is a 20-day moving average. If we look at this breakout, breaks out above the 10, above the 20. rallies up, starts tracing sideways, still closes above the 10, still well above the 20. We rally again, oscillate sideways, then we have a pullback. We have a pullback that collapses below the 10, but stays above the 20, right? So this is just giving you some inspiration on what kind of things you might look for with this specific kind of thing. Now, again, it needs to be made relative to the specific profit mechanism and the profile of your profit mechanism. That's why that process of defining it literally cannot be replaced. It has to happen, because without that, the trader genuinely is flying completely blind. If you're trading a strategy that you've never back tested in any capacity, the preferable would be to actually download data and then run it through Python and use feature matching and stuff like that. But you don't have to do that. That's not the only way to do that. I think it should be done, but you can get by just by running Monte Carlo simulations. That's easy enough by itself. But the other thing you do is just go back in time, right? Eyeball test it and figure out what's relevant to it by doing what we just did here, right? Just eyeballing it. Now, again, that's going to be less specific. So if the trader says something like, well, I don't really want to try to learn Python, it's overwhelming and I don't want to do that. One, I would highly challenge that thought. It's nothing that is that crazy. But that part aside, there's other ways to go about it, but there is a drawback to it. There is absolutely a drawback to it. The drawback is super clear. It's that you're not going to be able to make as well of an informed decision up front. Now, you can still build enough of a data sample in order to make a decent decision. It just might take a little while. So that's how. ZX says, ditto, I've let a few winners turn to dust recently thinking, what if it goes up another X%? Then it turned gold price ETF to be exact. Yeah. So let's take a look at one of those examples, because again, it really depends on the profit mechanism. So if we continue with this example in net, actually we can look at a live example in Palantir. Palantir is a great example because this trades on. You can literally see where the alerts are. You can literally see where I'm interested in price if it moves beyond. So did it start here? So again, when one of the entries was made back here, did I randomly pick like 151 where it didn't trade anywhere near that yet? No. For this specific profit mechanism, what I'm doing is I'm slowly following momentum and I'm ratcheting stuff up based on support and resistance. And again, why am I using those things? Because I've tested them. I know that they work in this context. So as this kind of thing is bouncing around, if you're using short-term moving averages, you get shaken out here once in a while, then you get back in down here. That's one way to do it. Or you overlay different kinds of signals. You say, okay, I'm going to use RSI to help me spot when it might be turning. But then I'm ultimately going to use just support and resistance levels as a secondary factor. So then as this thing is oscillating and moving up, let's say that the original stop based on this movement here was placed below this level, just kind of the 69 giggity handle. Then you get this really big rally and then it starts coming back down. Now, again, depending on the specific strategy, if this is a really short-term strategy, then the stop needs to be moved up. But if it's not, then you have more grace. So for example, let's say you were playing post-earnings announcement drift. This is a great example. And this is also a great example of how when it reverts, it tends not to come back for that quarter. So if you got in here expecting post-earnings announcement drift, and let's say that the stop is placed below the lows, the lowest close of the consolidation prior, which is typically what I would do. But let's just say in this case, you do it on the day of. So day of, your stop goes down here at 99. You got in at 103-ish. Rallies up. You can choose to either trace and follow the support and resistance here, again, depending on the duration of the trade, or you can just keep it here. But if you keep it here, here's what happens. It rotates over. You get a gap down that closes up, and then you finally get a close below right here at 101. So if you take your exit here, you lose $2. And then let's say that you want to give it another day, you lose $10 if you're managing in that way, just using support and resistance. But notice over the next quarter, like over this quarter coming into the next earnings release, it kind of didn't do shit. It went from here to here. Relative to this thing, 20% is very low. Now, again, that's still not an overall move to scoff at. That's still a decent move. But for this thing specifically, that's definitely very unimaginative. The point that I'm making here is that when you're coming up with the protocols to manage your profit side of the trade, you need to do the same exercise of defining the profit mechanism, profiling it, so that then you can apply a rule set that makes sense. Otherwise, it's just guessing. But in this kind of case, going out to the original example, with it being longer term, all I'm doing is picking the primary support and resistance levels that I can find, and then the stops get based on those. So this is actually a really interesting window in here. Let's take a quick look. I want to zoom it in so that it's not corrupted by the rest of the stuff. This is a really interesting move here, right? So this thing has a big gap up, and then it starts to roll back down. But again, if I was trading standard support and resistance on this, the stop goes again somewhere around here, 69, because this is where it consolidated, it dipped below, came back out. This consolidation. So I'm picking something below this, either 69, or if I wanted to be a little more specific, 63, but let's just call it 69. So big earnings move up, rotates down, comes all the way down, touches below, but goes back up. And then effectively, it's never seen that again. So it's just, for this kind of strategy, it's a game of me moving things with price to slowly trace it up so that I'm not giving up too much of it when it moves in my favor or coming out of it too fast. Now, there's a lot of nuance that goes into that, because sometimes if you're trading stuff that's less liquid, you can't really necessarily expect to get good fills on certain kind of moves. So that has to be factored into your decision making and so on. But to summarize all of that, do the same thing that you do for the loss side of the trade, but do it on the profit side. And the same exact logic that applies to the loss side is what applies to the logic side. You want to capture as much profit as often as you possibly can without too quickly getting out and cutting things that ultimately continue to do what you want without allowing them to roll over and crush you. So it needs to be made relevant to the profit mechanism, to the time frame that you're trading, and those kind of things. Any other questions? That was a good one. Anything else that we can hit on before you get your homework? And a quick overview of the next session. What is the next session for us? I'll tell you right now. Episode 4. Episode 4 is going to be a baller one, which is going to be building a cohesive options portfolio. I like that a lot. Now, the next episode, essentially, again, it just builds on everything that we've learned on so far. We want to figure out how to pull all these pieces together. Now, the homework side is really, really simple. It's to pick one of your strategies, which needs to be based on a profit mechanism, complete the profiling exercise, and then create management protocols. And my recommendation would be to just share it in the Discord when you're done, and peers will give you feedback. This is something that I spent a lot of time working in the Pro Plus workshops on with folks, and it's because it's super, super valuable. And even if your peers might not necessarily know what the right answer is, even the process of them asking you questions, how did you come up with this? That kind of stuff is super, super useful. So that's your homework. To pick one of your strategies, research the profit mechanism, profile it, and then refine your management approach. That's it. All right, gang. that wraps me up. Tomorrow, we will have our meme stock stream to see what's going on in the meme stock world. If you guys have any questions in the meantime, you can always reach out in the Discord, be an outlier. See you guys later.